All right, today we're tackling one of the most popular and honestly most debated strategies out there, selling naked puts. Is it this brilliant way to generate some extra income, or is it a ticking time bomb just waiting to go off in your portfolio? Let's get into it. Okay, just imagine this for a second. You've done your homework on a company, you really like the stock, and you've decided on a price where you'd be more than happy to buy it. Now, what if somebody came along and offered to pay you cash right now just for making that promise? Well, that's the powerful, powerful hook of selling a put option. And really, this whole strategy boils down to two things that pretty much every investor wants. Number one, generating some consistent income. Who doesn't want that? And number two, getting the chance to buy a stock you already like, but at a discount, so you get it for cheaper than it's trading for right now. Yeah, it sounds a little too good to be true, so let's break down how it actually works. To really wrap our heads around this, let's start with a really simple analogy. I think this makes it super clear. It's this simple. Think of yourself as an insurance company. Seriously. But you're not insuring a house or a car. Nope. You're insuring a stock's price for someone else. So you are the insurance company. And for selling this, let's call it a policy. You get paid an upfront fee. It's called a premium. And the best part is you get to keep it no matter what. So what's your side of the deal? Well, you're promising that if a disaster strikes, and in this world, a disaster is just the stock price dropping below a certain point, you'll step in and buy the stock. But if that disaster never happens by the time the policy expires, you just keep the cash. Simple as that. Free and clear. Okay, so the insurance analogy is a great way to get the big picture. But let's get into the nitty-gritty. How does this actually work when you're placing a trade? So before we get into the selling part, we have to understand what it is we're actually selling, right? A put option gives the buyer the right to sell a stock at a specific locked-in price. That's the strike price. So they're buying protection, a safety net. When you sell that put, you are selling them that safety net. You're the one on the other side of that deal. The process itself, it seems so simple, it's almost deceptive. First step, and this is absolutely the most important rule, you pick a stock that you would genuinely be happy to own, no exceptions. Then you choose a strike price. That's the price you're agreeing to buy it at. You also pick an expiration date, how long the policy lasts. Then you sell the put option, and bam. The best part, that premium, that cash, it hits your account instantly. But, and this is a huge but, that instant cash comes with a very real string attached. This is your obligation. If that stock drops below your strike price by the expiration date, you can get assigned. And what does that mean? It means you are now legally on the hook to buy 100 shares of that stock at that strike price, even if the stock is trading for way, way less on the open market. Okay, let's put some real numbers on this to make it super clear. Let's say we have XYZ stock and it's trading at 50 bucks. You decide to sell a put with a $45 strike price. And for doing that, you collect 150 bucks in premium. Now, if XYZ stock stays anywhere above $45, anywhere at all, that option just expires worthless and you keep the full 150 bucks. That's your max profit. Done. Your break even is that strike price minus the premium you got, so $43.50. But look at that last line. This is where it gets scary. If the stock totally tanks and drops to 35, you are forced to buy it at 45. That's $10 a share more than it's worth. Once you factor in the 150 you collected, you're looking at an $850 loss. Just look at the difference between that potential loss and the potential gain. And that right there brings us to maybe the most important point of all. This is not a set it and forget it strategy, not even close. The moment you sell that put, you are an active manager of a position that has very real risk. Basically, your trade can end in one of three ways. First, the best case, the stock hangs out above the strike price, the option expires, you keep the whole premium. Easy money. Second, the assignment case we just talked about. The stock drops, and poof, you're now the proud owner of 100 shares. But there's a third and really crucial option, active management. Look, you don't have to wait until the very last day. If you've made, say, half your potential profit, you can just buy the option back, close the trade, and lock in that win. Even more important, if the stock starts to turn against you, you can buy it back to cut your losses before things get really bad. A really common way to manage these trades is something called rolling. So imagine the stock is dropping and you're about to get assigned on that $45 put. Instead of just letting it happen, you could buy back that option, yeah, for a loss, but at the same time, sell a new put further out in time and maybe at a lower strike price, like $42. What does this do? It buys you more time for the stock to hopefully recover, and it lowers the price you'd have to buy it at. A lot of times, you can even collect a little more cash doing this, which helps soften the blow from the first trade. It's an active way to try and turn a challenging position around. Okay, we need to talk about the scary part now. And please, do not tune this out. This is the single most important part of this whole conversation. We have to talk about the catastrophic downside, this idea of asymmetric risk. This quote right here just says it all. Successful trading isn't always about how much you win. It's about making sure you never lose so big that you get knocked out of the game. And that big hit is exactly what can happen here. One bad naked put trade can wipe out the profits from 10, 20, even more successful ones. And this perfectly lays out the fundamental problem, the imbalance of it all. Your maximum reward? It's that little bit of premium you got paid up front. That's it. It's fixed. It's capped. It can never be more than that. But your maximum risk? Oh, that is substantial. We're talking about basically the full value of 100 shares of the stock. Let's go back to our XYZ trade for a second. In a worst-case scenario, say the company goes bankrupt, stock goes to zero. You would still have to buy those 100 shares for $45 a pop. Your total loss on that one trade would be $4,350. Think about that. You took on over $4,000 of risk for the chance to make $150. So here's the bottom line, the thing you have to burn into your brain. When you sell a naked put, you are taking on almost the exact same downside risk as if you just went out and bought 100 shares of the stock. If the stock goes down, you lose. Big time. But here's the killer difference. If you own the stock and it went to the moon, your profits are unlimited. With a short put, your profit is stuck. It's capped at that small premium. You're taking on all the risk of a stockholder, but you get none of the potential upside. And that imbalance, that's everything. So after all that, let's bring it all home. What's the takeaway? Is selling puts something that you should actually be doing? All right, let's recap the big points. The upside, the pro, it's obvious. You get paid to agree to buy stock you like anyway. It feels like a win-win. The downside, the con, it's huge. The risk you're taking is way, way out of proportion to the reward you can get. And the reality is, this isn't an advanced strategy. This isn't something you just jump into. It requires you to be watching it, managing it, and to really truly understand how much you can lose. Now, there are safer ways to do something similar, like using spreads to define your risk. We'll have to save that for another day. So in the end, it all boils down to this one simple question you have to ask yourself. Now that you know you're accepting this huge, substantial risk for what is, in comparison, a very small and limited reward, does that lopsided deal actually fit into your investment plan? Does it match your personal tolerance for risk? And that's a question only you can answer.